Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
If you're not visual, you don't need to do it this way, but I find it to be very helpful to look at stuff from a visual standpoint to sort of see where it needs to go and what happens when it gets into these places where I think it might be and how much will I make and how much will I lose. And based on all those things, then I can decide whether or not I should trade or not. And that's not to say that that's the only thing you should use to determine. Maybe fundamentals look awful and you want to go bearish because of that, but you don't want to go bearish on a stock that's got really solid fundamentals that's in an uptrend, right? So think about all those other things. No study, no interpretation is going to be perfect and give you everything you need to know. This is just one way to visualize these trades. Mostly I want you to get the concept of that I've got lots of choices. I've got puts and I got calls. I've got bearish and I've got bullish and I've got in the money, at the money, and out of the money. When you think about all those different variables, you've got a lot of different choices. I love spreads. I wrote a book on spread trading specifically because there are so many different types of spreads and there are so many different ways that you can structure spreads that you can almost always find one that will fit your needs. And so what I'm hoping to do here is to help you see how you can adjust and come up with a spread that will meet your needs depending upon whatever opinion you've got, whether it's bullish or bearish and on whatever index you're looking at. So let's summarize on this. Vertical spreads, what are the advantages? Well, debit spreads specifically will always require less capital than long options. All of the spreads we talked about were how to take a position because I'm bullish, how to take a position because I'm bearish. And if you use a debit spread, it will always cost you less than, if you're bullish, you could always buy a call option or sell a put option, right? Either of those things can happen, but it can be kind of expensive. If you are bullish and instead of buying a call, you do a debit call spread, that trade will cost you less because instead of giving yourself unlimited upside, which is typically the rationale for why a person buys a long call, you're not trying to make an unlimited amount of money. It doesn't happen very often, right? In fact, it never happens. Stocks can't go up to an infinity. You're just trying to capture the first few points. So instead of buying a call that has unlimited upside that you're never going to need, sell that unlimited part off to somebody else. You sell it off to them in the leg that you sell. That brings in a little bit of money. That lowers your overall cost. That brings your break-even down. That lowers your risk. That's why you do a vertical debit spread. You got lower break-even, you got lower outstanding capital, and you got lower risk because of it. You also, if you do a credit spread, will find that your margin requirements are significantly lower. The margin requirement on a spread is always equal to the maximum loss. If it's the case of a debit spread and you pay a debit up front, that's your margin requirements. All you have to do is be able to buy the spread. If you do a credit spread, you can calculate the maximum loss as we did, and that's the amount of your margin. Now, if you do a naked call or a naked put, your margin requirement is going to be significantly higher than it is on a credit spread because you've got a lot more risk. Now, the odds of that happening, again, are also fairly low, but you're going to tie up an enormous amount of capital. So what are the disadvantages? You always have limited profit. You have to be comfortable with the fact that you're only going to capture the first couple, 2, 3, 4, or 5 points when you do a spread. If your stock or your index just skyrockets and goes up 10 or 15 or 20, you're going to leave money on the table. You have to be comfortable with that before you put the spread on. You're also going to end up with more commissions. Regardless of how your broker structures his commissions, their commissions, the odds are pretty good that to do a spread is going to cost you a little bit more than buying a straight long position because you got two legs. You got a buy leg and you got a sell leg. At Schwab, we give you a break on the ticket charge when you do it as a single trade as opposed to legging in or out of it. But in most cases, it's still going to cost you a little bit more, so you got to be aware of that. And then the other thing, which is, and this might not mean a lot to most of you, and if it doesn't, that's okay, but a spread trade is not typically going to be eligible for price improvement through intermarket linkage. And what that means is this. When you enter an order to buy or sell an option, a single leg option, if it's sent to one of the exchanges and there's a better price on one of the other option exchanges, the exchange that receives your order has two choices. They can either fill your order at the price that the other exchange is posting, or they can ship your order to that exchange for execution. They aren't required to do that for two-legged trades. So if you put on a spread that has two legs, there's no requirement that an exchange match a price that another exchange might be posting for that two-legged order. So if you enter a spread away from the market and you see a better price on another exchange, you'll have to cancel that trade and re-enter it, and it'll go to the other exchange at that time. The exchange that receives your two-legged order does not have an obligation to match the price of another exchange. So not a huge issue, just something to be aware of, to keep in mind. And with that, I'll conclude, and I think I've got about 7 or 8 minutes or so to answer some questions. I noticed some of you were typing in questions while I was talking. Obviously, I can't read and talk at the exact same time, so I haven't looked at those. But let me just scroll back here a little bit real quickly and see if I can see any questions that I might want to answer. And you're welcome to type some in right now if you like, and I'll cover those with the time that I have remaining. So a question in here about MACDs. Again, I don't want to go into great detail about technical analysis. There are certain technical studies that I've found to be very reliable. There are some that I've found that don't have a lot of reliability, and you can find people on both sides of the fence in just about every technical study that there is. The reason I use support and resistance is because I think they're very simple, and I'm just trying to illustrate where indexes need to be in order for you to hit max profit, max loss, and break evens and things like that. If you come to a conclusion based on a simple support and resistance, and you need to add another study that you found to be valuable in order to help you pull the trigger on the trade, then by all means you should definitely do that. If you got mixed signals, then usually that's a sign that you shouldn't trade. You know, as a broker, it doesn't sometimes seem like we would tell you not to trade, but truth is, I've been quoted many times, and I've mentioned this in many things, many articles I've written, that sometimes the best trade to make is no trade at all. If you can't come to a conclusion, if you're not sure, if your different studies and indicators that you watch are giving you mixed signals, the best trade sometimes is not to trade at all. You should trade when you've got comfort in what you're seeing, that what you think is going to happen is actually going to happen. My goal here primarily was not to talk about the merits of the different indicators, but to help you visualize and set up spreads that make sense based on different strike prices and things like that. Yeah, so there's a question about a formula to use to account for probability of winning. Yeah, now the formula that I'm talking about, and it's real simple, again, take the maximum gain and compare it to the maximum loss. If you want to make that into a ratio, you can do that. Like in my last example here, I've got a max gain of 78 and a max loss of 222. That's about approximately a 3-to-1 ratio. If the ratio of max gain to max loss is 3-to-1, the inverse of that is the probability of profit versus the probability of loss. If I got a 3-to-1 ratio of max gain to max loss, then I got a 3-to-1 ratio of making a profit relative to a loss. Now that's not true for all option strategies, but it works quite well for vertical spreads. For vertical spreads, it's just the inverse. So, and again, that's just all based on the common sense principle that if I take more risk, then I've got a potential of making a lot more money, but I'm taking on more risk, so the odds of making that money are lower. If I take on a lot less risk, I've got a much higher chance of making money, and because I've got a much higher chance of making money, then the amount of money I'm going to make when I make it is going to be a lot smaller. It's just as simple as that.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.